Testing, testing.
Consolidation. Saturday, Monday down. I said, my client, I said, what did you do? I said, high and low days are highly
Unless you have your dad every day.
But it's against the grain. You can't do that. So I should buy Amara. Wake up. Initiated, right? Every it's going up again. Against the grain, the sun. And this one is good.
Testing, testing. 1, 2, 1, 2.
Stocks are all trading all over the place. Some are going down, some are going up. So it's very much a stock picking sector now, and not really looking at the overall sector. It's not a sector thing. No, everything is doing its own
Okay,
thing. Every stock's doing their own thing. There's a stock specific sector there. So you can say something. Well, guys. There's all this stuff here in front. Can I just close it off? Yep. Okay. Good morning. Good morning, remisers and clients of Phillip Securities. Welcome to our 11:15 weekly Monday market outlook webinar. For this week, we're going to give an outlook on markets as usual. And we will then talk about Singapore banks, which we have upgraded today. Okay, in terms of our macro asset strategy, we're actually overweight the US. Okay, we're optimistic going forward. Forward-looking indicators like core capital goods and housing starts actually point to a stronger second half of the year in terms of GDP growth. Okay, tapering of QE, the base case is end of the year, December 13. However, Friday's non-farm payrolls were really good at 195,000 jobs added. And if it continues this way, we do actually see that September 13 could be the start of QE tapering. For the Eurozone, contractions are easing off. Less bad is good. Now, Japan is also an overweight because ever since Mr. Shinzo Abe started his three arrows economic policy, monetary, fiscal, and structural reform, which is the last one, we have seen that animal spirits in Japan are certainly improving. There's a strong rebound in the PMIs. And we also have, what we're going to see is actually that there's going to be strong depreciation of the yen, and this will have a strong effect on the demand for Japanese goods. Okay, now if you think about the yen, why we think that it's still a short yen environment, because you have the US on a tightening path and you have Japan on a loosening path, so there's only one way for the yen to go. Now, because of this strong effect on Japanese goods from a depreciating yen, we see the analysts are furiously upgrading their earnings forecasts, which we can see that there's a 60% plus year-on-year expectation that earnings will increase. And for this reason, we think that Japan, which was on a short-term overweight before, should actually be outrightly overweighted. Now, for China, we have the underweight on the short term, and on the long term, actually is still an overweight. For the short term, I think the bears will stay firmly in control as the banking sector is going to be under pressure from much tighter short-term financing to rein in shadow banking, and of course, there's going to be impending even further interest rate liberalization, which will have net interest margin pressure. And since banks comprise nearly half the Chinese equity index, I think we're going to see some earnings. We're going to see a pretty bearish index in short term. Ultimately, though, everything China is doing now is correct from an economist's point of view in terms of favoring structural reform and eschewing short-term stimulus. So in view of this path, I think the outlook for China is actually brighter than it's ever been in terms of the long-term sustainability model. And from that reason, given such cheap valuations, I think many contrarians will certainly be looking at investing at these levels. Okay, ASEAN, we have Singapore on an overweight. Why? Because the second half of the year, we think the global economy will rebound. Hopefully, there will be no China hard landing to curtail this thesis. Malaysia, there will be post-elections belt tightening, so it's a neutral. Indonesia is an overweight because the fuel subsidies have been scrapped, so the budget will be vastly healthier. This is good for the rupiah and good for public goods investment, of which Indonesia really needs. Okay, Thailand in the second half of the year is going to see the start of its 2.2 trillion infrastructure program kicking off, 2/3 of which will be dispersed within the next 3 years, which works out to be 4.3% of nominal GDP per year. So on that note, we think Thailand is also an overweight. Philippines is a neutral because valuations are expensive, and there are no immediate catalysts post-investment grade upgrades. Okay, so in terms of our macro asset strategy, we still are pretty bearish on bonds. As you can see in the for U.S. Treasuries, we're an underweight. Mortgage-backed securities continue underweight. Investment-grade corporate debt is an underweight. High yield is a neutral. EM Asia, U.S. dollar investment grade is an underweight. And local currency is a neutral. High yields are neutral. Okay, given that we are in a tightening environment in the U.S., we're going to see more profit-taking at the long end of the curve and at the safe haven side of the of issues, or bond issues. So equities I have gone through already. Our forecast. Now I want to move to the bottom of the chart, which is commodities. Commodities we express as a neutral because although it has done a 2-year bear market consolidation. Afterwards, when we go through our market analyses, actually commodities could be in for a consolidation and then a move higher as they tend to rally after equities. Gold we have underweighted and continue to underweight since the October 12th, so this is one of our best calls, and we maintain that call. I won't go through the details. You can go and look at our GMAS reports, which have detailed why we're bearish on gold. Okay, so now I'll move you over to our market analysis.
Technical analysis will be done in 2 parts. The first part will be on cycle analysis to see where we are on the business cycle and hence from there where we are on the stock market cycle. Following that, we will talk about the technical analysis of major indices. So here we have an idolized business cycle for the 6 phases. This is an idolized business cycle, and essentially this is economic activity, this line over here, the sinusoidal line. If you're under the line, economy is going through a contraction, and if you're above the line, economy is expanding. So a simple explanation of this model is such that as the economy contracts, the Fed will try to stimulate the economy by buying up bonds to decrease interest rates. This adds liquidity to the market, and thus growth will contract less and finally eventually start to grow. Along this process, stocks and commodities will rally. When the economy grows to an appreciable amount or gets overheated, the Fed will try to decrease liquidity by selling off their bonds, increasing interest rates, and that will probably trigger off the bear market in stocks and commodities. So we believe that we are probably at stage 4 right now, in which this implies that the strategy to go forward would be to short bonds and to long stocks and commodities. Okay, so here is the arguments we put across for that. Here we have the dynamic yield curve, and we're going to show you 2 references for 2 different dates. This set of graphs over here is the situation in the year of 2000, just before the major bear market. As you can see on the left over here, this is the yield curve, which tracks the difference between long-term and short-term yields. Treasuries. And when the yield curve becomes flat or inverted, that usually preempts the bear market in stocks. This is the profile in the year 2000, and this is the profile in 2006. This is when the yield curve first got inverted. As you can see, it does do a pretty good job preempting bear markets. So where are we right now? This is where we are right now. So as the S&P has crossed the new heights, yet our yield curve is actually not inverted at all. It's pretty widespread. Okay, it's pretty widespread. So hence we believe, just based on this, stocks still have room to grow. These three charts are essentially the charts of the 10-year Treasury chart for price, the S&P index, and the GSCI futures, which is essentially commodities, industrial metals, and crude oil. For bonds, we can see we have been on an uptrend for the last almost 7 years, or actually more than 10 years, where only recently has the price of the bonds penetrated through our long-term uptrend. Hence, this is the first time that this trend has been challenged, and we have to ask ourselves whether this is actually the beginning of the bond bear market. We have to see if price can stay below this line, or will it actually correct back and get up here in the next few weeks. So there is some weakness over here. For stocks, we are still on an uptrend, and we are still taking on new highs. For commodities, we had an uptrend, but it seems that we have been consolidating over here. This seems to be more of a consolidation before a higher move rather than an actual reversal itself. Okay. So hence, we probably should want to look at this resistance line, which has been tested multiple times, to see whether there's a possible breakout. This is the same charts, but of a shorter time frame. So as you can see, most recently in the last 2 months, there has been a sharp sell-off in bonds, a small consolidation for stocks, and a continued consolidation for commodities. Based on these three informations, what can we say? Well, we can say that the yield curve is quite far from flattening, so stocks still have room to grow. Bonds may or may not have started their bear market, but it has shown its first sign of significant weakness. So we could be in stage 4 right now, which is when bonds is supposed to start its bear market. Stocks are still in uptrends. Commodities seem to be consolidating for another move. So based on this, hence our outlook implies that bonds will end lower. Stocks and commodities could push higher to year end. Hence, we are most likely somewhere in stage 4. Based on this particular investment cycle, stage 4 will essentially be around this area over here. So between cyclical growth, stocks and commodities still have room, still in bull mode. Okay, stock analysis of major stock indices. Okay, so here we see the price charts of the S&P weekly for the last 3 years. Well, the signal is unclear right now where we are. We must watch the S&P 500 to see how it behaves this week. Now, the S&P has been basically traveling in a channel for the last 2 years. And whether it continues down to a possible downside target, i.e. the bottom of this channel over here, or whether it breaks this 50-day moving average to go to the top, is unclear at this point. This is the daily chart of the S&P. for the last 9 months. So as you can see, this is exactly where we are right now. Now this retracement trend is going to be challenged soon. A break of this 50-day moving average, this has occurred last Friday, but we need to see price actually stay above this to confirm it's a true breakout. There is some evidence that it might continue onwards as the MACD over here has crossed, but the price has not confirmed this breakout over here. Okay, so conclusion, we wait for further market confirmation to see how price will test critical levels. If price cannot penetrate the retracement resistance, which is this dotted line here, if it falls back under this support of 1610, it will likely fall into a bearish scenario and might actually go back to the bottom of the channel. So we need to be observant and to see what happens this week. This is the NYSE Bullish percent index, and this is a breadth index. It's a breadth indicator of the S&P itself. Simply put, this bullish percent indicator, it measures the total number of stocks on the NYSE that is currently in a bullish configuration on its charts. So for example, right now the value is 64.97%. It tells you that 65% of all the stocks in the NYSE actually have a uptrend or bullish configuration right now. Well, how do we use this? This breadth index can give you hints on the strength of an S&P up move, and usually can preempt or show you inherent weaknesses in the price chart itself before it happens. For example, in January 2011 to July, you can see that the S&P was essentially consolidating and on a very small uptrend over here. But if you look at the bullish percent index, you can see that the number of stocks that actually lost its bullish configuration was actually much lower. So this actually shows that this consolidation was weak, and hence increases the chances of a correction over here. You can see the same thing over here, where in 2012, between March and May, the S&P was also consolidating over here, but yet the bullish percent index dropped, and this preempt that this move over here is weak. So today, where are we at? The S&P has been gradually going up, bullish percent index is down, but I will call this a minor divergence. So there's some weakness, but I don't think it's conclusive yet. We'll continue to monitor this as weeks go by. Okay, on to the Nikkei. This is the Nikkei Weekly for the last 3 years. The signal is inconclusive. You had our first major correction after a ginormous move from 9,000 to around 15,000, and this is just a retracement. I believe the signal is inconclusive at this point. This is still the Nikkei. One thing we can say is that on this retracement in July, we had a surge over here, which actually broke through this particular resistance line. So this line now becomes support. We have to see whether the price can actually stay above the support. If it can stay above this support, then it will most likely challenge its all high at 15,500. Hang Seng, later as you will see, is similar to the STI chart. We had our double top drop over here and a bounce off a support line over here. Though a short bounce to 1575, which is on this particular resistance level, is likely a continued intermittent uptrend is not confirmed yet. So we're not sure whether this will actually continue. Here are the two support and resistance lines. The stochastics have a bullish crossover, so this lends some weight that there will be a bounce back from this point over here to this top resistance level here. Whether or not it continues to come down for a second leg of sell-off is indeterminate right now, but it's a possibility. Okay. The Hang Seng, looking closely, we can see that price actually retraced back to the first gap here, has retraced, and has come up again. So only time will tell whether we can clear this second resistance line over here. Okay, the STI. Similar to the Hang Seng, the STI has support and resistance lines as follows over here. And the first test of the 1310 support, a short bounce is expected. Whether or not it can head back to the resistance at 3260 depends on whether we can successfully clear this 50-day moving average. So if we can clear this, it implies a target of here, 3284. Okay, the MACD, however, on the weekly has crossed downwards. So intermediate caution is needed, but bear market is not confirmed yet. Okay, the stochastics are good for short-term cycles, and it has crossed upwards. So again, it lends itself to evidence that we might have a move further up to 3284. On a closer look, we can see that this is the support and resistance. So right now, I call this a ascending triangle, and we are attempting to break out this blue line over here. If we can successfully break out of this blue line, then yes, the next immediate target will be this resistance at 3260. Okay. But after this, will there be a leg down? We are not discounting the possibility. We are not removing that possibility. So the bullish scenario is as follows. A break of the ascending triangle at 3170 and staying above it confirms a short-term up move to between 3210 and 3260. A bear scenario will occur if prices will fall below 3060, which is over here. If it falls below here and stays below it, then it will trigger a bearish scenario. Okay. And that's all for technical analysis.
Hi everyone, this is Ken from research. I covered the banks. So today on the Singapore banking sector, as you guys would have probably read, this morning we upgraded the banks. On the whole, we upgraded DBS and UOB from neutral to accumulate, and we upgraded OCBC from reduce to neutral. So why is this so? Right. First, we'll talk about the impact of increase in interest rates. As you guys know, we expect that the Fed would start tapering off on the QE, probably either September or December this year. And this is not going to be the one that will move your short-term interest rates, but rather after that, we expect that probably end 2014, right? We might see an increase in the Fed rates, and this would directly lead to an increase in short-term interest rate. Right? We also talk about the outlook for the banks and why we prefer UOB and DBS. So as you can see over here from the chart, right, you can see that for the short term, right, it's remaining relatively the same. But on the long term, right, you can see that actually the market has already moved in terms of long-term interest rate on expectations that the QE is going to taper. And with the tapering of the QE, you expect that the markets actually increase the long-term interest rate. However, that said, right, even though long-term interest rate has already increased, the banks are typically, most of their loans are typically on a short-term interest rate pricing, and therefore the long-term interest rates may not affect the banks as much in increasing interest income, right? And once again, we expect that short-term interest rates would gradually increase once the Fed rates increase in possibly end 2014. So, why is the impact of interest rates increase when they eventually increase? Well, when the short-term interest rate increase, we would definitely see an increase in interest income, right? However, take note that we do not expect this to be a very quick process, and we do not expect this to recover immediately. We don't expect whatever is lost to recover immediately. This is because typically loans are priced based on a benchmark plus spread. So a benchmark could be like SIBOR, or something like that, right? Maybe 3 months SIBOR, right? And but the thing is that the spread, right? What happens is that previously, the spread has actually been decreased, right? It's been decreased. So you can see that, for example, your mortgage, right? Your mortgage spread has already been decreased, and this decrease is not going to revert immediately when Fed rates increase, right? Instead, right, you will only be reverted back to norms when those guys they review the loans and the spreads are increased, right? So therefore, we are going to expect to see a bit of a drag on the spread, and therefore the increase in interest income is probably going to be like a bit slower, right? One more positive thing about this ending of QE and the increase of interest rates is that we actually expect there to be higher demand for bank loans. The reason being that right now the demand for bonds has already slowed down quite a bit, and well, since companies no longer so readily get low yield interest rates bonds issuing it to the market, they could potentially be increasing their bank loans, and this is actually very positive, especially since most of these companies tend to be of very high quality. However, one thing to note is that with the increase of interest rates, you also need to watch out for credit costs. So where does this credit cost come about is from your non-performing loans. As interest rate increase, and the interest expense increase, it's likely that some companies will start having some problems trying to service the loans, and therefore this will lead to a higher non-performing loans, and directly this will increase your specific provisions. And also like to bring you to this red line over here. This red line is actually the general provision divided by the total number of loans. And as you can see, right, there's actually been a decrease, right, in the red line. For example, for OCBC, it's decreased from 127 to 94 basis points. For UOB, it's also decreased quite significantly, right? And so what happens is that the reason for the decrease is that as the loans quality get the non-performing loans ratio below, then in a way we see that the loans quality is pretty good. But when your when your interest rate increase, likely you would deem that the risk on your total loans would be higher, and therefore we would probably see a potential for there to be a higher general provision required. And this impact alone would already cost approximately, to revert back to previous levels, this is possibly going to incur 500 million of loan allowances, but this is one-off, right? So for UOB and OCBC, based on our sensitivity analysis, this is probably going to be around 500 million of credit costs to revert the general provision back to historical norms, right? And for DBS, it's lesser because it has not dropped much, right? However, of course, we expect that the overall it to be overall positive on our earnings because given an assumption that net interest margins increased by 40 basis points, this is approximately estimated to bring in $1 billion of higher net interest income for the banks yearly. So what's our outlook for the banks? As you can see, as the banks have guided previously that net interest margins should stabilize at approximate current levels, right? And this is actually on the back of a huge decline, especially in 2012, and it's been declining since 2009, right? So we expect that this would stabilize and that loans growth will be healthy for FY13, right? And also we can see over here that that for DBS and UOBs especially, the fees and commission has been very strong. You can see a very nice uptrend, especially for UOB and DBS also not too bad. This is from mostly from wealth management. This is mostly from wealth management and also from trade and loan-related fees and commission. For UOB, I believe it's mostly from wealth management, right? This wealth management includes your bank assurance, unit trust. This has been doing very well for UOB and DBS and OCBC, right? So on non-interest income, for this second quarter alone, we expect, as always, non-interest income is very volatile. It's very hard to predict, but our call would be that for this quarter, DBS is probably going to do pretty okay, right? This is because we continue to see renminbi appreciating against the US dollar until the mid of June, and likely DBS is very involved in these FX transactions, and this is likely to help them get higher trading customer flows and higher non-interest income for DBS. On OCBC, we're actually slightly more pessimistic on non-interest income for second quarter. This is because OCBC has a Great Eastern insurance arm, and insurance companies typically would have to hold long-term maturity fixed income to be able to match their liability, right? And given that they need to hold on to these long-term liabilities, given the recent drop in long-term interest rates, likely you're going to see that they may have some mark-to-market losses on this long-term fixed income, and this would be a negative on OCBC's P&L. However, quarter on quarter, given that first quarter was a really good quarter, we expect that net profit will probably be lower quarter on quarter, but likely higher year on year. Sorry, just year on year would also depend on what the non-interest income would be, but yeah, we expect to see a slight drop quarter on quarter from a high base. However, for FY13, we are positive overall because of the bottoming up of the net interest margins, and that loans growth continue to be healthy. So once again, why we prefer UOB and DBS? For DBS, you can see over here from the chart on your right that for OCBC, for DBS, the current PB ratio is around 1.18 times. This is much lower compared to UOB and OCBC at 1.3, 1.4. Right, so once again, DBS is currently trading at the lowest price to book valuations. Although you could say that, oh well, the ROE is slightly lower, but however, given the strong momentum that has been building up for DBS, it may be unfair to say that it may be unfair and relatively cheap for them to trade at 1.18 times price to book. For UOB, we continue to see exceptionally strong fees and commission, and in fact, the unlike the other two, the price to book is currently at currently not above the 5-year historical mean. OCBC is trading above that, and so is DBS. And we believe that at this price, UOB continues to be relatively undemanding. Moving forward, you will see a bit of volatility in the share price, but we expect that the share price would end higher from current today's prices. And now for questions. The first question from the floor that we have over here. For the target price for the banks, what would be our time frame that we are looking at? For these prices, we're actually looking at a time frame of approximately 1 year, right? This is based on a, cannot hear. Yeah, this is based on a time frame of 1 year. However, it may be faster or it may be slower, but approximately 1 year. Any questions from the floor?
Sorry, just then there was one chart on the divergence between the bond yield versus the stock price. Is that more on the S&P? That's more S&P, right? Rather than.
The question from the floor was the chart that shows the bond prices and the stock prices, the divergence. The yield spread, you mean?
Yes.
That was for the S&P.
S&P. So
yes.
Do we have any historical? Do we have anything on the Singapore market on that?
Not so well correlated.
Not so well correlated. Because of the bond market is too small.
Not as long history.
No history.
Maybe one cycle. The rest would be there.
So can you repeat the last question again?
Okay, does that
is the information for the Singapore market?
Is it relevant for Singapore market?
Well, it is relevant because for the S&P and the Singapore markets are very heavily correlated. So on the long term, right, where the S&P goes, the Singapore market will also go as well. So I think that's where it's important. Do we have any direct data that connects bond yield spreads in Singapore itself, right? Then we're limited with the amount of data we have. But one thing we do know is that the S&P is heavily correlated to Singapore markets.
Okay, so maybe we can extrapolate from there.
It's possible, yes. Other questions? Okay, the question is, on your technical analysis, you mentioned that we are probably at phase 4 of the business cycle. Assuming we are still on the bull trend, how long more can the bull trend up before it reaches its peak? That's a good question. At this point, I would venture to say, I think a good guess would be at least a year for year end, but we won't really know for certain until we see certain signals seen. So, for example, we see the yield curve inverting. That would be a particular signal, or if we see major trend lines being broken. But until we see these signals, right, I think that at least for the end year, it should still be coast can be clear for move up. A bit, there could be short-term weakness.
Hello. Yep. There's a question right here on S-REIT and perpetual shares saying that the S-REIT whether it will fall further from here, and also I think there's just a new question that just came in asking if Singapore REIT is still in the bull trend. I would not think that the Singapore REIT is currently in the bull trend. I think that it will be weak. This sector-wise will be a bit weaker than usual. In terms of stock picking for this sector, I think it will be more specific on the counter, whether there's a lot of asset coming in, and we will be more cautious on this sector going forward. Yep.
Sorry, one question. I think the Singapore market is because more people out of the country, like to the US, and if you look at the FX rate itself, the Sing dollars versus the US dollars.
Okay, we have a question here on the weakness on the STI, whether it's due to fund flows. Looking at the SGD US. I mean, definitely there's money has been flowing out of the STI. But that's it. This is common across just about all the Asian markets and all the ASEAN markets. And you've seen that, you know, in terms of the economic outlook, we're generally positive, right? China notwithstanding. Okay, so China to us is the wild card. And in terms of our market analysis, there could be another leg down, but generally we are also leaning towards the positive side for stocks, right? So these fund flows easily reverse themselves, right? So they're not exactly leading indicators of anything. If anything, they seem to be laggard, because unless you have real-time indicator of where the fund flows, it's hard to tell, right? Yeah. So that's how we see it at the moment. Any more questions? Okay, we have questions on real estate here. I'll pass you back to our real estate analyst.
Yep. Hi, Lucas. I'm covering the real estate. The question is current cooling measures, I suppose, on property affecting the sector's counters fundamental. We do not really see a very strong correction from here. We believe that the current cooling is a bit more of a fine-tuning. Obviously, that there will be certain effect on the luxury and also on those investors looking for that second and third property. But we believe that it is more of weeding out the last few of such flippers of the property market. So we do not believe there will be a strong correction, although the market is still currently weak for the luxury private properties. So do watch out for counters which are focusing on such developments. And there's another question on my view on the strategy for the property stocks for the next 3 to 6 months. We believe that the price right now is the current price is kind of reflective of current underlying market right now already. We believe that the strategy that you guys should actually look out for is more of counter specific. look at their launch and whether there's a change in strategy for the counter, and if there are any big movement and if there's any big news on it, we will further comment on it when the time comes. But for now, the property outlook is still kind of weak. Yep. Thank you.
Sorry, in the property stocks itself, will there be any potential, any of these property stocks, because the valuation is low, any privatization potential, any
There's a question on the floor right now regarding the potential for privatization of certain property stocks. For now, I don't think that is a theme at the moment. I think that right now we do see some of the current trend is we are looking more of like listing up their assets into REITs. But they're actually waiting for a proper market timing, because right now the in terms of the REITs, the valuation wise is still kind of weak. Yeah, yeah, waiting for the right time to actually list. But we do hear of and realize that we do hear of certain market information saying that there are interested parties in spinning off REITs and so on and so forth. Yep.
Sorry, one last question. Regarding the REITs itself, I mean, it's been going down for quite a while.
Yes.
So, do you see a bottom somewhere?
Okay, and the question on the floor right now is actually, is there a bottom when it comes, as in the REITs are weakening, and whether the price is bottoming out? Do we see a trend? We do see at current yields that is starting to slow down. We start to realize that it's stabilizing, and certain counters and although certain REITs are still holding strong, we do feel that this is kind of like nearing the bottom. Obviously, we couldn't say with 100% definitive, but we do see the price stabilizing. And we do see some REITs becoming more and more active in pulling in additional assets. So we believe that the price may take a turn around current levels.
Okay, there's a question here on whether we're right now at the right price to enter the US, and then there's also another question here on whether QE may have disrupted the idealized business cycle. Okay, I'll leave the first part to my other colleague who will talk about the right price, but I will talk about whether we have had a disruption, right, on the idealized business cycle. We actually did think that could be the case. However, when we looked at where we were struck by actually that we could actually really be at stage 4, right? Because the U.S. economy has had a very weak expansion, and in the first half it was extremely weak, and then now we're seeing a pickup again in our leading indicators, right? So and it just nicely coincides with talk of monetary tightening. So on that note, we thought, yeah, actually we could really be at phase 4. So it seems to fit, right? And so we have, we're not saying that it's definitely that, but all the evidence is pointing there despite quantitative easing. Okay, on the whether it's a right price to enter the US, I will pass you on.
Okay. Okay, so the question we have is the current price right time to ride on the US market? Okay, so here we have the weekly chart of the US S&P index, and what I will say is that there's two possibilities right now. The first possibility is that there is another leg down towards the bottom of the channel. This probability cannot be discounted. Okay, because we can actually retrace all the way down to this bottom channel, and we can still claim that we're not on an uptrend. See, however, what we need to ascertain is that this is the daily chart. So what we need to see is two things. And the two things is, well, I think that if the price drops from here and breaks this support line, which is about 1610, if we break that, the chance of retracing all the way down to the bottom channel is a possibility. However, right, if the price can convincingly break through this retracement dotted line here, right, then it's a possibility then that we can resume the uptrend. So either way, this week we need to see whether we can break this retracement line or whether we actually break through the support line. So at this point, we have to monitor.
What is the US market is trading the PE ratio?
Okay, we have a very good question here on the PE ratios of the S&P. Okay, so you should look at our global macro report that was issued this morning, right? Go in there and you will see that the S&P is actually trading at valuations below historical. Okay, so the average, the dividing line is 16. Okay, so in the last cycle, we've generally traded above 16. In this cycle, we're generally trading between 12 to 16. Okay, so we are actually cheap, if you think, or rather not expensive lah. Okay, we're not expensive relative to the last cycle. So actually claims that this is all liquidity-driven rally are false, right? Very much of it has been an earnings-driven rally. Okay, it's only in the last 6 months when earnings was flat and you see a rise in the PE ratio of the S&P, and that drove the last 6 months bull market in the S&P. But if you're looking at the last if you're looking at the 3.5 years before that, it was all earnings because actually the PE ratios were declining. Okay, but the index was rising, so it was all earnings. All right, so from that perspective, we're not expensive, actually. Okay, thank you for attending this webinar, and we're glad for everybody who logs in and attends physically here in the 6th floor presentation room at Raffles City. Thank you and see you next week.
Can